Boa tarde a todos. Nós podemos começar e eu vou falar em inglês por causa do nosso apresentador aqui. Okay, so good afternoon to everyone. It's a great pleasure to have you all here. I am here representing our dean, Professor Liege Bernucci, and also our vice dean, Professor Judici, on this presentation that will be made by Professor Jason Jackson, for the Career Development Assistant Professor of Political Economy and Urban Planning at MIT. His presentation and his stay here with us is being sponsored by MIT's Latin American office. We are very thankful to them. We are also very thankful for the help of Amigos da Poli, Friends of Poli, that has made a fantastic contribution to our school. And so I think I should just welcome to be here Professor Jackson. Thank you very much, and I would like us to give him a very warm applause.
So thank you very much for that kind invitation, welcome, and good afternoon, everyone. I apologize. In another life, I would speak Portuguese, and I do this entire talk in Portuguese and be very impressed with myself and so forth. But sadly, languages are definitely not one of my gifts. But I will I'll try to take the advice that my grandmother, who I grew up with, I grew up in Jamaica. My grandmother always told me, growing up, you speak way too fast. So I'm going to do my best over the course of the presentation not to do that and to heed my grandmother's warnings and advice. So I'll just give a little bit of background on myself as well as on some of the things that I'm going to talk about today. So I teach at MIT. I do work in political economy. And for me, what political economy really means is thinking about societal transformation, fundamentally. Political economy, I think, really dates back to, my take on political economy really dates back to the classic political economists, Smith, Marx, Ricardo, maybe even earlier, Bernard Mandeville, and so forth. People who really were interested in observing and trying to make sense of a massive transformation that was taking place in their time, which of course was the rise of modern capitalism. This is in the 17th and early to mid 18th centuries. Of course, Marx follows, and then we get into the 20th century with Weber and others, who again are trying to understand big transformations, the rise of the interstate system, the emergence of the modern nation state. So really epochal, huge transformations that took place in our world. And I give this background because I think we're once again at a moment of significant transformation. It may not be quite at the scale of the emergence of capitalism, the sort of transition from feudalism and mercantilism to capitalism, but in many ways I think it may come close. And I think this transformation is being prompted significantly by the rise of new technologies associated with things like artificial intelligence, advanced automation, so all the kind of tech buzzwords that we all have become familiar with. And all of which play into questions that are circulating around the future of work. This question as to what will happen, what might be the effects of the emergence of these new technologies on work. Will there be jobs in the future that resemble the jobs we have today? Particularly in developing country contexts like Jamaica, where I'm from, like Brazil, in Asia, in Africa. There's also a serious question about whether the kinds of jobs that were available in the current countries in the global north that facilitated their ability to develop widespread wealth might be available to our countries given these new technologies. Will these technologies support labor or might they be labor replacing? And so these, I think, are very crucial questions for us all to consider. But I think there's a very important caveat that one has to put in from the very beginning and will underpin a point that I'll try to make throughout my conversation with you today. And that is, even though technology is playing an important role, a central role in driving these transformations will not be, I will argue, a pure outcome of technology. That is, technologies will not determine the kinds of transformations that we have started to see and that we will continue to see in our economies at the national level or at the global level. Technology certainly can facilitate change, but ultimately the decisions that are made are decisions that are made by those in the positions of power. So at the firm level, these are managerial decisions. Do I invest in technologies that might replace my existing workers, or do I invest in technologies that might support my existing workers? Similarly, they depend on decisions that are made at the regulatory level, so policy decisions. Do we direct investment resources to support technologies that will support our current labor force? Do we invest in skills and training so that our workforce is better able to utilize the kinds of technologies that are being developed? Do we put in place policies that might encourage greater cooperation between business and labor, such that the decision as to whether to invest, that a manager makes, for example, as to whether to invest in new robotics, for example, that might replace technology, might instead be seen through a different lens, one where those new technologies, in fact, may aid workers. I always think of the example of Japan and the use of cobots. That is, robots that are designed to work alongside human workers in ways that support those workers, doing tasks that may be too physically difficult or potentially dangerous. And so those are the kind of tasks that you'd like to shift human workers away from. But really the idea of technology working with or operating alongside human workers, I think is a central sort of question that we want to consider. So with that sort of general view to sort of, I hope, lay a bit of groundwork for the things that I'll talk about today, I'd just like to turn to some of the specifics that I'll focus on. So some of my own research in this area in recent times has focused on the rise of ride-hailing. So we're all familiar with ride-hailing. So this is 99 in Brazil. This is Uber, of course, in Latin America and around the world. Didi in China. Didi also, of course, is in Brazil through 99. Lyft in the US, and so forth. These new technologies that are facilitated by the things that everybody here has either in their pockets or potentially in their hands, right, which is a GPS-enabled smartphone, which allows for providing on-demand services. Mobility services have been at the forefront, but as I'll show later on, there are a whole slew of additional services that are central to this new provision, this new digital technology, of which ride-hailing is simply one. So what I'm going to do is to use ride-hailing as a lens, as a case, really, through which we can think about some of these transformations that are taking place through the rise of new technologies, and through which we might consider and hopefully discuss some of the points that I made a few minutes ago about the extent to which these transformations rely on or driven by technological change only, or are also driven by changes at the managerial and policy levels. Okay, so with that, so this is just a sort of a slide that sort of depicts, what we already know. So the companies that are at the forefront of our global economy these days, or many of the companies that are at the forefront of our global economy, are in fact technology firms, and they operate in a variety of domains. So I know the text is a little bit small, so I'll just point out what these point to. But of course, at the top, in areas such as IT and infrastructure, we have the familiar giants: Google, Amazon, Facebook, Apple. So 4 really big American companies. But crucially, of course, this is not just a field that's dominated by American firms, or even more generally firms from the global north. So we have Chinese firms that are central, Baidu, Tencent, and Alibaba, for example. And these firms are providing, in many respects, the core of the digital infrastructure upon which many of the transformations that we're observing in the global economy are taking place. They're also driving significant transformations, and I'll just point to a few things here. Perfect. So artificial intelligence, so companies like Google, Amazon through Alexa, Apple Siri, for instance, are key examples. Scrolling down a little bit further, we can think about areas such as e-commerce and retail, the kinds of transformations that we see in the ways in which we buy, and crucially, the ways in which we sell goods. This piece is essential because the ability to buy, we're all consumers, so we all buy things. But one of the things that these digital platforms are providing is a basis upon which we might also be producers, such as in ride-hailing, for example, but through which we might also be engaged in entrepreneurial activities, for example, such as through selling goods on platforms like Amazon, like Alibaba, and so forth. And then I'll just point to one other, which is fintech and payments. This is an area where we're seeing really interesting developments and rapid transformations. This is the rise of digital payments, use of digital monies. And these, of course, are driven, well, they're driven by companies like Google and Amazon Pay are important, as is Apple Pay. But actually, the companies in the global north that operate in fintech, I would suggest, are the least interesting. Much more interesting is what's happening in the developing world. In country context and regional context, such as Latin America, Asia, Africa, where conventional forms of digital payments or credit cards are not widely dispersed, and of course, the level of banking is relatively low. The emergence of these digital platforms provide a huge opportunity to provide digital payment services that are much more broadly accessible and therefore potentially much more ubiquitous in the economy than conventional means. And so therefore we see the importance of payments, for example, through WeChat in China, driven by Tencent, as hugely important. So this is just to give a sort of general sense of some of the arenas in which we're seeing transformations in the digital economy. Turning to work, and this is just using a graphic put together by the ILO. I like this graphic because it helps us to center the future of work, and crucially the questions that arise with the future of work in the midst of a number of key issues, all of which I'll touch upon briefly over the course of our conversation today. So the future of work raises questions such as job quality. So in the ride-hailing context, this is essential. To what extent do ride-hailing firms provide good jobs? So it's clear that ride-hailing has transformed urban labor markets to the extent that they have provided huge opportunities or widespread opportunities for workers to provide mobility services through the platform, providing rides in cars, delivery services in motorcycles, something that a feature that's exploded in Brazil over the course of the last couple of years, and similarly has exploded around the world, in Asia, Africa, as well as in the United States. But the question that often arises is, even though it's clear that ride-hailing firms are providing opportunities for employment, they're controversial to some degree because the question remains, are these good jobs? Because of the wages that are paid, because of safety concerns. Again, one might think about delivery. So in Brazil, for instance, in Sao Paulo, delivery via motorcycles has risen significantly in the last couple of years, but so have motorcycle accidents. And so to what extent do the pressures that drivers may be under to deliver on time, pressures guided, of course, by algorithms, so by the computerized systems that underpin platforms, might they lead to increasing the risk of accident on the parts of these drivers, are important questions that we have to ask. So the future of work raises questions of job quality, and of course the number of jobs, so providing lots of jobs, but also raising questions about the quality of those jobs. Then of course it raises questions about social protection. So to what extent do we have institutional systems, policy systems in place in our countries, again, especially in developing country contexts, to provide adequate social protection for workers in these domains. It raises questions, as I noted before, about wage and income inequalities. So this is the question about the wage levels that are being provided in digital services generally and in ride-hailing particularly. And finally, this question of social dialogue and industrial relations. This goes back to where I began, when I noted that the question as to whether the ways in which work of the future might be transformed has less to do in many respects about the technology itself, about the technical details of technologies, and much more to do with the kinds of decisions that are made at the managerial level, to a large extent, at the regulatory level to some extent as well. This speaks to questions of industrial relations, the kind of relationship that exists between management and workers, and how that relationship may shape different kinds of decisions, different investment decisions, different managerial choices when it comes to investments in and purchases of, and of course deployment of new technologies. So this is a really nice way to just think about some of the key issues that are in orbit around this underlying question about the future of work. So turning for a moment again to ride-hailing, I just want to raise a couple of sort of key points about ride-hailing that are important for us to bear in mind, I think, as I go through my talk and as we speak and have a conversation in Q&A afterwards. And there are two sort of broad things that I'd like to point out. The first is that mobility, generally, so mobility, the ability to move about space, especially in urban spaces, is the key to economic development and to social justice. And this is so for a number of reasons. Mobility is crucial for access to employment. So think about the Sao Paulo context, for example, where we have massive spatial inequalities. So not only income inequalities, as we know, so Brazil, along with the United States, are amongst the top 5 or 6 countries in the world with respect to income inequality. So income inequality is an important point. Income inequality can be high across both developing as well as industrialized country contexts. I mean, the US, people tend to forget about the extreme high levels of income inequality in the United States. But we also have forms of spatial inequality. And in cities like Sao Paulo, for instance, these manifest, of course, with lower income groups living, for the most part, on the outskirts of the city and higher income groups living within the city. Of course, this is inverted in the American context, typically, up until maybe the last 10 or 15 years when cities have been seeing a lot of revitalization and higher income groups moving into the center of cities. Of course, in the US in the 60s and 70s with the suburbanization processes, many of the middle and upper middle classes moved out of the cities into the suburbs. So typically in the American context, getting into the 1990s and 2000s, wealthier groups higher income groups lived on the outside of the city, and lower income groups lived within the city. In Sao Paulo and in many developing country cities, it's the opposite, right? But the thing that holds across both domains is the fact that inequality is spatialized. Mobility, therefore, is crucial. Because in order to address these kinds of spatial inequalities, it's important to figure out ways in which people who are in lower income areas, for example, can access as easily, by which I mean as quickly, as cheaply as possible, can access means of income earning opportunities. So getting jobs in the city, being able to travel into the city and not have it take, for example, hours, which is often the case, and be very costly. So they're crucial for questions of access to employment. Mobility also has implications for fair wages, as I noted before, and spatial equality, and also gender and racial justice as well. And I'll come back to this a little bit later on when we talk about regulation. But part of the logic or the logic and reality of ride-hailing and the kinds of opportunities that it's presenting in the labor market also turns on the extent to which the opportunities that are provided are equally available to men and women. And also are equally available to members of different racial groups, whether we think about this in context in Latin America, in the United States, where again, income inequality is racialized and gendered in very important ways. So mobility is key to thinking about development and social justice. Ride-hailing as a transformation of mobility, particularly in urban spaces, has massive potential for transforming urban life. And this is an important point. So there are lots of critiques that have been laid at the doorstep of ride-hailing, and I make many of those critiques myself, and some of them you'll hear this afternoon. But I want to make the point very clear that there's huge potential in ride-hailing as a mode of transforming urban mobility for having positive effects in transforming urban life. Crucially by addressing some of the issues that I noted above, having to do with employment, wages, spatial, gender, and racial equality. So technology can play a huge role in transforming urban spaces. However, in order for this to happen, particularly in the ride-hailing context, and this is unique, I think, to ride-hailing more so than other areas of technological transformation, such as advanced automation, it's crucially important that business and government work together productively. And this will speak to some of the issues around regulation, for example, that I'll come to later on. But I think this is a very important point that we want to make. Okay, having sort of provided a bit of an introduction and laid out a few key points, let me turn for a moment to a global context. So let's take a step back and think about how the world has transformed, not over the longue durée that I started off in the beginning. So we won't begin in the 18th or 19th century, as much as I love talking about the 18th and 19th centuries, but rather in the course of the last few decades, so in the post-war period. So one way of thinking about this, and this is geographic data that's taken from the World Bank. So the World Bank has really cool tools to sort of play around with data in a variety of contexts. For example, this is economic growth data that's sort of visually displayed. The key is down to the right, and so those numbers represent growth. But really what you want to pay attention to are simply the colors. The darker the color, the higher economic growth is. The lighter the color, the lower economic growth is. So starting in around the 1960s, and what I want to point to is periods of transformation from the 60s and 70s into the 80s and 90s, and then into our current period in the 20-teens. So in the 1960s, what do we see? We see, fairly good growth in North America, in Canada, and the United States, but high growth in Latin America, high growth in parts of Africa, and high growth, in some parts of Europe. Of course, in the 1960s, in the Latin American context, as well as the African context, much of this growth was driven by commodity exports, as well as a massive industrialization that was taking place in countries, in regions in Latin America, in Africa, as well as, of course, in Asia during this time. So we see really high growth in Southeast Asia, moderate growth in India, and of course, low growth in China. So China is still emerging in the Maoist period at this time. And this picture, of course, starts to change when we get into the 1970s. So growth slows down globally, largely due to crisis, which I'll talk about a little bit further. But areas that are insulated from the global economy and which are starting to facilitate big change, which of course is China, we see really high growth. In the 1980s, again, we see growth sort of slowly returning to parts of the global south, Brazil most importantly. As well as China and much of Asia, we continue to see really strong growth, as well as in the Asia-Pacific region, more generally in Australia and New Zealand. This slows down to some degree in the 1990s. Then in the 2000s, in the last 2 decades that I'd like to focus on, this is the sort of picture that we see. So slowing growth in most of the world, bar China, right? So, and this is a feature of the 2000s that we're really quite familiar with. And then if we think about getting to the 2010s and where we are today. So today we see high growth continuing in areas such as China, in countries such as China, in much of Africa, moderate growth in North America and in Europe, and slow growth, moderate to slow growth in Latin America, and slow growth, of course, in Brazil. Of course, we think about Brazil post-2014, we know some of the reasons why. So how can we make sense of this sort of transformation over the course of the last several decades? I'm going to provide a suggested periodization, which is a simplification. So it's difficult to capture the global economy and growth in a single slide and try to explain everything, of course. But I'm just going to try to make 1 or 2 points using a simple threefold periodization. What I want to suggest is that we can think about the period from around 1960 to the present in 3 main periods. The first, so let me just start to sort of say, the chart, the line graph essentially indicates economic growth. And so the global economy, of course, is cyclical. So we see, of course, it's not a straight or a neat line. But the things that we can note are the following. One is that in the period of the 1960s, I could have maybe drawn a trend line through this, but average growth in the 1960s is relatively high compared to these periods. So that's one sort of just stylized observation that I want to point out. The second is that we can think about these periods of crisis. So This is in the mid-1970s. Does anybody know what was taking place in the what may have caused this? Oil crisis, exactly, right? So we see the oil crisis here, we see financial crisis. Think about the 1982 peso crisis in Mexico, for example, as well as other crises in Latin America and other parts of the developing world, and ultimately in the United States with the Wall Street crash in 1987 in this period. And then, of course, there are no prizes for guessing what this is. Right, so it's a global financial crisis, right? So we can see on one hand these moments of crises, but we can take a step back and generalize a few things. So relatively high growth during this period. This period was known as the golden age of capitalism. And this golden age held certainly in the global north, in North America and in Europe and Japan. But also parts of the global south as well. And again, the growth in the global south was driven, as I noted before, by commodity exports, by a very accommodating global trade system. So, of course, the global trade system is very interesting today with China and the US engaging in a trade war. But a very facilitative global trading system for developing countries. This is the time of the GATT. This is before the WTO, before more generally neoliberalism, which I'll come to in a moment. So this is a period where developing countries are essentially given a lot of room to basically adopt the kinds of growth policies, development policies, industrialization policies, export policies that they want. And this was reflected in strong growth really in Latin America, in Africa, and in Asia. It's really across the developing world. This is also a period when the development model rested to a significant degree on commodity exports, certainly in developing countries, but the industrialization model really rested on manufacturing. And central amongst manufacturing were industries like automobiles. Automobiles globally was the industry that became synonymous with manufacturing in the post-war period. And it's worth noting automobiles in the Brazilian context because, as we know, automobiles played a central role both in the imagination as well as in the real policies that were put in place in post-war Brazil. So this is Vargas's and other key figures in Brazil's dream, which of course has been made a reality as Brazil became a powerhouse in automobile production. So this period, I might suggest, is, again, this is a simplification, but is one that could be associated with manufacturing globally and epitomized by the automobile industry and by firms like GM, Mercedes, Ford, Toyota, right? So American firms, European firms, and Japanese firms that sat at the top of this hierarchy. Notice all these firms are from countries in the global north, even though production was taking place around the world in Latin America and in Asia outside of Japan. Then we might turn to thinking about this second period, which I'll suggest was from maybe around the mid-1980s into the 2000s. And it's one where we see the rise to importance of new global industries. Electronics, I would suggest, in the manufacturing sector is crucial. Now, this is not to suggest that electronics weren't important here. They were, especially from the 70s onwards. Nor is it to suggest that automobiles are no longer important. They still are. But I would suggest that the 80s, 90s, and into the 2000s were periods that were characterized by the importance of the rise of the electronics industry and companies like Sony, Apple, and Samsung. And again, if we think about the companies that are at the sort of lead of this kind of transformation, we of course see, again, Japanese firms, so Sony, just like we had Toyota in the previous period. We have Apple, just like we had Ford and GM in the earlier period of manufacturing, automobile manufacturing dominance and the role of American firms. But crucially now we have companies like Samsung, right? So firms that emerged from countries that previously were developing that now sit at the top of global supply chains. And of course, if I were to take a poll, I would make a guess that there are probably more Samsung phones in people's pockets in the room right now than there are iPhones. But that's a guess. But I put a little bit of money on it, I think. So we see the rise of developing countries, right? So we see this story of transformation, I would suggest, is reflected at the country level as well. And of course, if we think about the current moment, so in the 20-teens, which I'm suggesting is a moment where we're seeing another globally important industry emerging, in this case, digital services. Of course, we have American firms represented like Uber, but also firms like Didi, right? And so again, we think about the rise of China and the current dominant role or hugely important role that China plays in the global economy. Now, thinking about the digital economy and turning from this sort of broad and, as I've noted, simplified perspective on the global economy or global perspective, how might we think about this in the context of Brazil? And this is where I'm looking forward to lots of conversation, because I'm, of course, very much, I'm coming from outside of Brazil and very much a student of Brazil and trying to understand more of what's taking place here. So let's start with growth. So think about growth. This is per capita GDP growth in Brazil from 2000 to the present. So over the course of the last 2 decades, it looks a little bit like this. You can't really see much, so I'll help. So here's a global financial crisis. It would have been very hard, I'm guessing, for us to have picked out the global financial crisis in Brazil without looking down at the bottom scale to sort of see, well, what happened with the crisis, right? Because it's just that's a bit of a tick, right? And this, of course, was striking in the global context, right? So remember the chart that we saw, the global economy, we see a massive downturn in economic growth. But Brazil largely rode through the global financial crisis not too badly, certainly on the back of commodity exports and so forth. Much more important, perhaps, in terms of a downturn has been the more recent 2014 crisis. Well, if we think about this in terms of economic growth, this becomes even sharper. So again, we see the dip in Brazil. So this is GDP growth now, right? So growth rates in percentages. So we see the dip, the global financial crisis here. But we see a much, much bigger impact more recently in 2014. And the 2014 crisis, of course, is to a large extent, from a global perspective, is unique to Brazil, unlike, of course, the global financial crisis. But we're here thinking about questions of technology and work, right? So what was the employment impacts? So again, if we overlay unemployment, so this is unemployment in Brazil over the exact same period. This is all World Bank data, by the way. So the global financial crisis, there's obviously an employment effect. But the employment effect, sorry, this is unemployment going up. So this is unemployment falling over time, so the situation is getting better. There's a bit of a rise in unemployment around the time of the crisis, but not very much. It's about 1%. Then unemployment continues to fall, so things are getting good. Life is great. And then we get to this point in 2014, and we see a sharp uptick in unemployment. So we see a big impact on unemployment of the 2014 crisis. Why is this important? Well, if we go back to this chart, what I try to suggest here in my periodization is that this period post-crisis, post-global crisis, this period in the 2010s, might be seen as a period when of the rise of digital services globally, particularly in contexts such as ride-hailing. But when did ride-hailing really become big in Brazil? Well, actually around 2013, 2014, if you think about the emergence of 99. Of course, the leader in the sector initially, or one of the leaders in the sector initially in Brazil, a homegrown firm. And then, of course, with the entry of Uber around 2014, right around the time of the crisis. So how might we think about this relationship? Now, I'll just very quickly say, as a social scientist, this is something that, this is a religion and a mantra that we always say, that correlation is not causation. So I'll say that very clearly. Correlation is not causation. I'm not making a causal claim. However, one of the things I'm going to suggest as we continue on is that an important factor, I'm going to suggest, in the success of the digital services model generally, of which ride-hailing is the poster child, is the availability of a willing and able labor force. So ride-hailing in the United States emerged. So the first ride-hailing app was created in 2007, 2008. It was called Zimride. Zimride was the precursor to Lyft, and Lyft was created before Uber. So Lyft was created around 2009. Uber was created in 2010. And Uber really started to grow around 2000, as well as Lyft, really started to grow around 2010, 2011, 2012, when they expanded from just working with licensed carriers, whether it be taxis or limousines, to, of course, the model that we're familiar with today, when in most city contexts around the world, where essentially anybody with a car or a motorcycle or a three-wheeler, depending on where you are, if you're in Latin America, the US, or Asia, or Africa, can provide mobility services. This coincides in really interesting ways in the, I can say from observation in the US context, with the massive unemployment and long-lasting unemployment that's followed the global financial crisis. And similarly, I'm going to suggest, and we can talk about this afterwards, that the success of ride-hailing in terms of being able to attract drivers onto the platform, right, to solve the network effects problem. So in order for ride-hailing to be successful, you need lots and lots of drivers, right, which facilitates being able to drive down costs of the ride-hailing service, which in turn, of course, helps to attract passengers, attract riders. And there's a tight interconnection between these two, which is a network effect which is a reflection of network effects. I'm going to suggest that just from observation, it's interesting that the success of ride-hailing, the growth of ride-hailing coincides in many country contexts with periods of rising unemployment. And again, this makes sense because ride-hailing firms provide employment opportunities. And if there are new sources of employment in a period of unemployment, then of course this is, one would expect this to be taken up. So I just want to suggest that there may be a relationship between these two that we can talk more about as we go on. All right, so having sort of sketched out, on one hand, a picture of the global economy, also sketched out a little bit of what's happening not only globally, but also in Brazil, and made some suggestions as to the links with ride-hailing. Let me say a little bit about this relationship between economy and technology that I spoke about earlier. So I suggested that the kinds of changes that we will see and are seeing in many respects with the emergence of new technologies, AI, advanced automation, and so forth, I'm suggesting are not simply outcomes of the technology itself, but rather turn in important ways on political economy factors, on relationships between management and labor, for example, on regulation, which of course is not independent regulation. It is also an outcome of business, government, and labor, and in many contexts, civil society decisions. So what does the political economy of the global economy and political economy of national economies look like over the course of the last couple of decades? So this is a chart. This chart has been, tells a story that's a common one in the United States and a common one in many other parts of the world. And what it shows is the relationship between labor productivity and the distribution of income from, which is the distribution of gains from production, which of course are captured essentially in wages. So the idea behind this essentially is captured in this first part of this chart, this period from 1950 up until about the late 1970s, which I earlier referred to as the golden age of capitalism. What this suggests is that labor productivity and compensation for workers, so workers' wages, basically moved in lockstep. That is, as workers became more and more productive, they were able to capture the gains from their productivity improvements through their wages. So they're paid for being more productive, essentially, at a more or less one-to-one rate. This is in the United States, sorry, I should note. This data is from the US, this is not global data. But then something happens around the late 1970s. And we start to see a very, very sharp divergence between, so the solid line here is labor productivity. This dotted blue line is average compensation. And so average compensation means compensation for both managers and workers. And this green dotted line is compensation for non-managerial workers. So workers on the factory floor, for example. We see a big, so up until this point, everybody essentially was shared more or less evenly the benefits of productivity improvements in the 40s, 50s, and 60s into the 1970s. Then we see a big inflection point. I should note that one of the reasons that the golden age of capitalism is considered to be golden was not just the growth story that I told before, where you saw average high growth across the global economy and really reasonably well distributed in parts of the global north and the global south. It also was considered the global age of capitalism, especially in industrialized country contexts, because of the relationship between management and labor at the time. This is a time in the US and in Europe of high unionization rates and of, at least compared to today, relatively congenial relations between management and workers. This is not to suggest that there weren't strikes, that there weren't tensions at various points in time. Of course there were. But nevertheless, the relationship between management and labor was relatively good, and to a large degree, this can be interpreted, this relatively even split of the productivity gains that we saw over the course of the decades from the 40s to the 70s, the relatively egalitarian sharing of those gains can be seen as an outcome of this relatively good relationship between business and labor. But something changes. So what does that change? So this is what might be referred to as the Fordist Keynesian period. So we have Keynesian policies, coupled with sort of Fordist industrial relations in the 40s, 50s, and 60s. What I'm going to suggest that happens here is a couple of things. So of course we have the oil crisis. We have the sort of reaction to the oil crisis, for example, in the United States with the jacking up of interest rates. We have the impact of the rise of interest rates in the global south, especially in Latin America, especially in countries like Brazil, Argentina, and so forth. So the emergence of the crises of the 1980s as privately held debt levels shoot up. Right, this is a story, of course, which everyone in the room is very familiar with. But also have other changes that take place as well. So we have globalization, which here I'm going to use to refer to the growth in offshoring and outsourcing. So the global fragmentation of production. So production becomes fragmented. So you have less vertical integration. So it's less likely to produce a car in a single factory, for example, and much more distributed across suppliers, not just within the same country, but increasingly outside of the country as well. We see the same thing with electronics and so forth. So you see a fragmentation of global production in this period that I suggested was driven by manufacturing growth in industries like automobiles and electronics. And so we see the impacts of some of these kinds of changes. Again, this data is from the United States. We see the impact of some of these kinds of changes in the share in the distribution of the share of gains from production between management and workers. So part of the story that I'm telling is a firm level story, right? So this is changes in production, the way in which firms do manufacturing production, for example. But also part of this is a policy story as well. And so this is the element, of course, which is associated with neoliberalism. This is the decline in social safety nets, the weakening of legal rules, for example, in the United States around collective bargaining. So we start to see the weakening of labor, both on the policy and legal side, at the same time as we're seeing these transformations by these sort of firm level decisions to offshore and outsource production. And so I'm going to suggest that these play a key role in this split between where we see the gains from productivity. The key thing to note is over the entire period, again, the solid black line is labor productivity, continues at the exact rate, more or less, from 1950 until today, 2018. What changes is right here, is how those gains are distributed between managers and workers. And so this is what I'm going to suggest is the political economy of production. It's the political economy of the relationship between management and labor. It reflects decisions that are made at the managerial level. It also reflects changes in the broader policy environment as well. But the ultimate outcome of these kinds of changes is rising inequality, right? This growing gap between income that accrues to management versus income that accrues to labor. We see this in a couple of other ways. So the chart before was just the United States. This chart compares the same thing, the changing labor share of income between countries in the global north and those in the global south. So the top blue line, for which, as you can see, we have much better long-run data, is in industrialized countries. And so we see the fall of the labor share of income. So this means that in 1970, labor captured 54.5% of income relative to management, right? And owners. Owners are those who own shares. It doesn't have to be the sort of actual owner of a company. For a publicly traded company, it'd also be shareholders as well. So labor goes from capturing about 54, 55% of income in 1970, and this falls all the way down to less than 40%. Sorry, this is the scale, I beg your pardon. This falls down significantly over the course of the next few decades. And we see a similar story in developing countries as well, where the labor share of income started lower, started at around 39%. So the scale for developing countries, so the red line is over here. So in the mid-1990s, labor captured about 40% of income, and this has fallen consistently, if if with some volatility over the course of the last couple of decades. So this is one way of thinking about the political economy of inequality over the course of the last few decades. I'll skip this chart. And so this raises a number of questions. One, it points to, it comes back to the point that I made at the beginning about the extent to which the changes that we are starting to observe and that we're going to continue to see in our economies, the extent to which they're driven by technology, or whether they're shaped by this broader political economy. It also, of course, raises the question, what do we do about it? So, of course, there are many things that we need to do. These are complex problems. One, obviously, has to do with the sort of governing ideas and norms that underpin neoliberalism. That's big and difficult, but certainly one that we should talk about. But another area that is perhaps in some respects first tied to the bigger question, but to some degree more concrete, has to do with preparing workers for the kinds of transformation that we're seeing with the rise of the digital economy. So if this period post-crisis, if this period of the 2010s and what we expect in the 2020s and 2030s is going to be increasingly driven by the digital economy, more so than manufacturing, at least manufacturing using techniques of the 60s, 70s, 80s, and 90s, so advanced automation, for example, in the manufacturing context, or digital services, or digital technologies used in service provision, then of course skills and training become really important. So what's been happening in the context of skills and training? So I'm just going to show a few slides with data that's all on Latin America. And this data is CIPAL data, ECLAC data, and compares some of the larger economies in the region. So the first of these slides this is just to give us a picture of what's taking place comparatively across the region with respect to training, skills training, in the context of digital technologies specifically. So this is specific to digital technologies. So we can see what's happening and we can think about whether we're happy or not. So this chart first shows, oops, I beg your pardon. This chart shows two things. First, a number of programs that are available. So these are university level programs in countries in Argentina, Brazil, Chile, Colombia, Mexico, Peru, and Uruguay. And what we see is that Brazil, there are many more programs in Brazil than in any other country in the region. Mexico is also quite, I mean, of course, sorry, this is based on the number of universities per million inhabitants, so there's a control for country size. So we see lots of programs in Brazil and Mexico, much less so in countries like Argentina, surprisingly, Chile also sort of surprisingly, and Uruguay. Sorry, the number of programs is here. So this is the control, I beg your pardon. So per million inhabitants, what we see is, whereas there are many more programs in Brazil, of course, once we control for the Brazil's population size, this starts to fall. So Chile is the leader along with Uruguay, Brazil doing not too badly, Mexico not too badly, Argentina and others trail a bit more. Similarly, if we turn to formal training programs in digital technologies, we see a similar picture. Again, in Brazil and Mexico as the largest countries in the region, they have the most programs. But once we start to control for population size, the story changes a little bit. For example, Uruguay is way ahead of other countries in the region in this respect. So the third thing is the short training courses. Again, we see a kind of similar story. So the length of programs matters a lot because there are different investment decisions at the worker level in engaging in longer versus shorter programs. So university programs that may be 2 to 4 year programs, for example, versus shorter programs that may be under 2 years, that may be more affordable, more accessible perhaps to workers, especially workers at lower skill levels, lower income levels, and so forth. So this tells a picture about short training courses that are available in the area of digital technologies. And then I think this is my last slide like this. This is, again, training courses in advanced digital technologies. So this would be advanced automation, just skills in operating advanced robotics. These would be training courses in things like machine learning, so advanced statistics. So artificial intelligence is essentially just machine learning, which essentially is just statistics. It's a big simplification, but one which simply serves to point to what the underlying knowledge that's required in these areas is. So this chart points to what's taking place in these more advanced digital arenas of digital technology. And then let's skip this. This is just a number of teachers and so forth that are available in these contexts. So let me show two more things to do with training. The first is this chart. So what this chart shows is the correlation. Again, this is just a correlation. This is the outcome of a simple regression. This wasn't done by me. This is also CIPAL data. The relationship between formal programs in digital technologies and the use of the sort of productivity of factors of production, so of capital and labor. And what we see, worryingly, are most countries in the region sort of doing similarly, so Peru, Mexico, Colombia, Chile along a similar trend line, but Brazil and Argentina underperforming and Uruguay overperforming. So there's variation in the region in terms of the sort of response to training in the context of digital technologies. And then finally, this is just a graph on enrollment. So one good thing that we see throughout the region is enrollment in higher education in these areas is consistently increasing, even though, of course, as we've seen in some of the slides before, the distribution of this is quite different across different countries in the region. Okay, so finally, let me spend the last maybe 3 or 4 minutes coming back to ride hailing. And so thus far, what I've tried to do is to first make the claim that what we're observing in the context of the emergence of new technologies is underpinning or has the potential to underpin a global transformation in the way our economies work. This transformation is happening in the context of increased inequality, structural inequality, much of which has to do with decisions that are made both at the firm and the policy level, so globalization, neoliberalism, and so forth. And that the emergence of digital services, of which ride-hailing is just one, but which is the most visible and perhaps right now likely the most important in terms of the number of participants, the extent to which it's widespread. Ride-hailing provides an important and useful case through which to think about some of these kinds of changes. So what I want to do now in my last few minutes is to sort of take a step back and zoom back out to the global level and to think about, well, what's actually happening with ride-hailing. So first, just a chart, this is not mine, it's taken from Counterpoint, just to think about the distribution of ride-hailing firms around the world. And the point that I want to make here is that on one hand, it's, Uber, for example, is synonymous with global ride-hailing. So I could have said, every time I said ride-hailing, I could have said Uber, and it would have meant almost exactly the same thing to everyone up until this point, right? In many cases, Uber has become indistinguishable from ride-hailing. But what I wanted to do with this chart is to make clear that there are lots of firms that are operating in these spaces. So we know this, of course. I mean, in Brazil, we have 99, we have Uber, we have Cabify, etc. But just to show a kind of global picture, sort of visually, of the different firms that we have, many of which are quite giant. So obviously, to start in North America, where ride-hailing emerged, we have Uber and Lyft, so this is a duopolistic market. Of course, in Latin America, in Brazil, we have 99, we have Easy Cabs, Uber, etc. In Europe, we have Uber in some parts of Europe, Taxify, which is now called Bolt, it's an Estonia-based company. They're also quite widespread across Africa as well as Uber. In Russia, we have a Russian firm Yandex, Didi obviously in China, so in China it's virtual monopoly. So Uber, as we know, exited China in 2007. Exited China in 2016, sort of 2016, 2017, after engaging in a mutually destructive price war with Didi. Didi essentially bought them out. Uber stuck around in Southeast Asia for another year or so before exiting Southeast Asia as well. They also were engaged in a destructive price war with Grab. Grab is a Singapore-based firm. This is Grab here. And then obviously in South Asia, we have Ola, which is the Indian-based firm. We also have Uber and so forth. So there are lots of firms around the world, and this is quite a competitive field, is one of the key takeaways. All these firms competing with each other, though there's a caveat to this, which I'll come back to in a moment. I'll skip this on regulation in the interest of time. So on one hand, we see a globally competitive market between lots of ride-hailing firms. On the other hand, there are lots of interesting connections between these players. So I'm going to show two charts, neither of which are mine. But the first sort of shows cross-investments by two key players in the ride-hailing context, which are not named Uber. The first that I'll point to is familiar, of course, in Brazil, which is Didi. So Didi, of course, is a ride-hailing firm. And as I've mentioned, as an outcome, a partial outcome of the competition between Didi and Uber, Didi has a significant stake in, Didi and Uber are cross-invested. But Didi also has made big investments in other ride-hailing firms, such as in Grab, obviously in 99, in Careem. Careem is a Middle Eastern based, Saudi-based ride-hailing firm. In Taxify, which as I noted before is Estonia-based and is one of the dominant players in Europe and in Africa. So Didi is cross-invested in many of these firms. The other key key entity here to think about is SoftBank, which many in the room may be familiar with. SoftBank is a Japanese or Japan-based investment entity. So it has a number of investment vehicles in its portfolio, and it's been very aggressively investing in ride-hailing firms around the world. And so this clouds to some degree, I want to suggest, the competitive picture. So the story of global competition that I told before, when we realize that in fact many of these firms are cross-invested in one another. So again, I'm a political economist, so think about the political economy of finance at the global scale and the scale of investments in ride-hailing firms starts to raise a number of interesting questions about the kind of direction and pattern that we might see emerging in global ride-hailing. And investments is really crucial because, as everybody knows, in almost every context that I'm familiar with, ride-hailing rides are all subsidized by venture capital. Right? So they're subsidized by the early-stage capital that underpins many of these firms. So the prices that we pay when we take Uber or 99 typically do not reflect prices that are outcomes of what you might think about as unsubsidized business decisions. So the back-end sort of finance in this context is really important to think about. I'll skip this. So here's another chart that sort of speaks to this issue and sort of also projects a little bit ahead into what the future of ride-hailing might look like. Again, this chart is not mine, but it's really nice, so I like to use it. And what this chart does is show the interconnections, and I know it's difficult to see some of the circles in the back, so I'll tell you what some of them are. What it tries to show is the sort of networked relationships between ride-hailing firms, between global financial firms, as well as, interestingly, between conventional automakers as well. So the way that this chart is organized, these charts could be organized in different ways. This network could be depicted in different ways. But the way this network is depicted here is with ride-hailing firms at the center, of course, Didi right in the middle. And so what it shows first is Didi and its investments in Uber, in Lyft. Didi, I forgot to mention, of course, is not in the US, but they sort of are in the US because they're heavily invested in Lyft, as well as its investments in Grab, the Southeast Asia-based firm, and Ola, the South Asia, the Indian-based firm that's a big competitor to Uber in India. So all these firms are interrelated, or many of these firms are interrelated. The second thing that it shows, these red circles basically are financial firms. So you have, for example, China Life Insurance, BlackRock, the American financial house. You have some others. You have SoftBank, and so forth. So all these global financial players that are invested, not just in one of these ride-hailing firms, but in many cases in a number of them. So based on the size of the investments that these firms have, they may have significant say in some of the managerial decisions that are made. So as an example, for instance, it's strongly believed that the head of SoftBank had a significant role in suggesting to Uber that they pull out of Southeast Asia, for example, where they're invested, of course, in Grab, as well as being invested in Uber. So this kind of price wars, this heavy competition that I started off by noting, is actually competition. If you think about the financial firms that are behind ride-hailing, this is unproductive competition between two entities that you own yourself, is one way potentially of thinking about this. So that's a sort of a provocation in thinking about how this is all organized. And then finally, the other firms that are here as well are the conventional auto firms. So Toyota, Tata, Volvo, Fiat are all invested in Uber. GM is as well. GM is invested in Uber. It's also invested in Lyft. BMW is invested in Ola. Honda is invested in Grab. And does anyone take a guess as to why these firms might be, the auto companies might be invested in ride-hailing? What does ride-hailing promise? What's one of the positive things that ride-hailing promises? To reduce vehicle ownership. So from an urban planning perspective, from an environmental perspective, that sounds great. It maybe doesn't sound so great if you're an auto company. The final firms that are here as well are the tech firms, which I'm going to now call conventional tech firms, which shows how much the world has changed. I'll refer to a firm like Google as conventional. So Alphabet, so of course Alphabet is the parent, is the holding company of Google, is invested in Uber. They're one of the early investors in Google. They made a lot of money. Their biggest venture, they have a venture arm. Their venture arm's first large investment was in Uber. It's a good gamble. Microsoft is invested in Uber. Of course, so are some of the Chinese tech firms, Baidu, Tencent, Alibaba, and so forth. Companies like Apple are invested in Didi. So Foxconn also is invested in Didi. And so we see also that the technology firms also sort of tied in with this global picture. So this is simply to say that when I make the point that we're in the midst of a global transformation, this is another way of thinking about this global transformation, this interconnectedness between high finance, between the conventional automakers, the ones that I said were at the heart of the golden age of capitalism, the electronics firms, the technology firms, which I said were at the heart of the period of industrial growth and global growth in the 80s and 90s, are all heavily invested in digital services. And these digital services are not just ride-hailing. So ride-hailing in many respects is just the tip of the iceberg. Why? Because in fact, it's more than just providing rides. In fact, ride-hailing could be a portal to multi-service platforms or super apps. So take Gojek, for example. Gojek is the Indonesia-based ride-hailing company, which provides rides, particularly through motorcycles. I mean, that's where they began. So in Indonesia, if anyone has ever been, the motorcycle taxis, which are dominant in the city, are called ojek. So Gojek is a play on ojek. But they don't just provide rides. They provide, rides on motorcycles, so car rides, but also food delivery, but also supermarket delivery, package delivery, financial transfers, so digital payments is huge. You can get other kinds of services, personal services, massages, get your house cleaned, a beautician, get your hair done, your nails done, tickets to the movie. You can also purchase tickets for public transit, medical services, right? So these, what many of the firms, the platforms have realized, especially outside of the US, so this sense actually Uber and Lyft are the most boring of the ride-hailing companies. The most interesting ones, in fact, are in the global south, where there's been a recognition that platform technologies offer the possibility of aggregating a whole slew of services that can be provided in these contexts. And of course, the key to the provision of these services are low labor costs in these contexts, right? So it all comes back to labor once again. Finally, just for fun, is the future of ride-hailing autonomous vehicles. I always like to show these slides. I'll just show them for fun in 2 seconds. So the idea of autonomous vehicles is not new. It's old. This is an image from the 1950s when cars would be traveling on American highways and a family would be playing, in this case, I think they're playing backgammon in the car. The caption says, "One day your car may speed along an electric superhighway. Its speed and steering automatically controlled by electronic devices embedded in the road." So sensors in the road in today's parlance. Highways will be made safe by electricity. No more traffic jams, no collision, no driver fatigue. All right? So the kind of utopia of autonomous vehicles is not a new one. It's an old one that dates back at least to the 1950s. And of course, many of us used to watch the Jetsons. I don't know if I'm dating myself by saying that, but maybe yeah. And of course, the modern view of autonomous vehicles is this, right? So sensors not embedded in the road anymore, but embedded in the vehicle. This is for people who pay attention to or are interested in autonomous vehicles and smart cities. This is one of the big debates: where should sensors be located? Should they be on the vehicle or in the infrastructure? This is also a political economy question. If you want to control the degree of control in these technologies is shaped by some degree on where the technology rests. So it's probably good for the world if they're embedded in the infrastructure, then they can be shared. But if you've invested a lot of money in developing new technologies, you probably want them to be embedded in your own vehicle. We can talk about that. And so the autonomous vehicles of tomorrow look, if anything, a lot cooler than the ones of the 1950s, maybe. And we all will be like this one day, presumably, zooming from hundreds of miles away to our places of work every day, while not playing backgammon or board games anymore, but instead playing video games. So I'll stop there right for now and say thank you very much and look forward to talking about this more.
Thank you very much, Professor Jackson. Very interesting presentation. And now we are open for questions. I would ask everyone to make questions in English. If you need any assistance, we can help you with the translation. Okay?
My name is Peterson. I'm a student here. So recently I've read an article on Forbes talking about this not so far ahead bubble burst on tech companies. And not so far ago too, we read about some news about the billionaire losses on Uber, for example. So my question is, if you, from a perspective, of course, is this ecosystem of shadow economy apps like ride-hailing apps is a solid and long-term ecosystem, or is fragile to an eventual crisis on tech companies, and what does this loss represent in a general sense to this ecosystem?
So thanks very much, Peterson. So it's a great question. So one of the interesting things about the digital economy, I think, generally, of which ride-hailing is a part, turns on what I was saying about the extent to which much of this, at least on the ride-hailing side, is being subsidized by various forms of early-stage capital, venture capital, angel financing, and so forth. One sort of interesting distributional piece of this is that the very, very wealthy, so venture capitalists, as a sort of broad class, in fact are subsidizing the rides of people who use ride-hailing, which for the most part is, I would say, the middle to upper middle class in most parts of the world, but less wealthy than venture capitalists. So there's a distribution of income that's interestingly taking place. So that's just a kind of funny aside. But a more crucial question is tied to this, and that has to do, I think, with if and when this money will run out. And if it runs out, then can the model, for example, in ride-hailing, continue to survive? So one immediate effect that one might expect is a rise in prices, which might make ride-hailing less cost competitive than it is right now, which we would expect would reduce ridership. And so that throws at least the ride-hailing model into some degree of question. But I think your question is more generally about tech. So thinking about other areas, I think some areas seem to have better growth potential than others. So I think digital payments, for example, especially in the developing country context, seems to have quite strong and positive and genuine profit-making potential. And I think this is one of the reasons that we're seeing ride-hailing companies or tech firms that began as ride-hailing companies, perhaps I should frame it that way, like Gojek, like Grab, like Ola in India, increasingly turning their focus to digital payments, to fintech. And so I think there's strong hope here. In other areas, I mean, it's more questionable. I mean, Google as the most important, the largest, and sort of, again, Google is sort of is synonymous with big tech more than anyone else except maybe Facebook. But I could put Facebook here as well. They still generate the vast majority of their revenues from ads, which is a very conventional way of, a non-techie way of making money. So will that change in the future? Will that ad revenue source be challenged? If so, then I think big tech companies like Facebook and Google will face a really big challenge. But I think that's one way of thinking about the landscape and the possibilities going forward.
Good afternoon, Professor. Pedro from here as well. Getting away from this ride-hailing, but still making contact with the context. We are living in a world that tends to give different answers to different kind of problems. I mean, in the United States, you have cities with big blocks, and in Europe, you have smaller blocks with high density neighborhoods, let's say. But generally, there is still a need for education in order to use either form of like ride-hailing or let's say autonomous vehicles and together solution in a high-density city. So what's in your perspective the Brazilian solution for that? I mean, because our investment in education is not very powerful than it had to be. So how do you see education in Brazilian scenario?
Yeah, thank you. So, unsurprisingly, I'm on academics. I think education is important, but we all do, right? So education certainly is key. I think the challenges are manifold in contexts like Brazil and other developing country contexts, and quite frankly, also in the U.S. So my colleagues, for example, some of my MIT Sloan colleagues, Paul Osterman, Tom Kochen, for example, spend a lot of their time really trying to think about ways of improving what in many places are quite weak skills training programs in the United States. So this is a general problem, I think, in the global economy, in both developing and industrialized countries. Both in trying to figure out ways to harness investments towards skills training in the digital economy or in advanced technologies more generally. So again, advanced automation is really crucial here. So even though my own work is focusing on digital services, I don't want us to lose sight of the role of manufacturing. It's still crucial in the global economy, as are other areas as well, so commodities, agriculture, etc. And we might think about ways in which new technologies might start to transform those industries as well. So a big challenge is trying to harness investments towards these kinds of programs. A related challenge, and this is one that you hear from educators so in the US context, for example, I'm participating in a project in Detroit. So Detroit is sort of home of the American automobile industry, but a city that is the reflection of the downturn of manufacturing in the US, with all the attendant problems that follow. Spatial inequalities, racial inequalities, etc. Detroit is sort of like captures it all. And I'm involved in a project there with a few colleagues, and part of that project is engaging quite closely with heads of vocational training schools, so two-year colleges, junior colleges, and so forth. So precisely the kinds of places that are training workers for jobs, again, sort of on the factory floor, so manufacturing sector jobs, jobs as operators of industrial robots, and so on. And a big problem that they talk about is the challenge that they face when they try to interface with business to understand from business what kinds of skills they need. So if I'm the head of if I'm running a vocational program, then I need to know precisely what kinds of skills I should be trying to impart to my students so as to make them competitive on the labor market and be able to get jobs in the companies in the industries in which we're operating. And they often point to this problem in trying to come to common understandings with companies about the kinds of education, the kinds of programs, the kinds of skills that are needed. And this is a conundrum because it's unclear, again, in a context like Detroit, where the skills training organizations are right there. They've been there for decades. The auto manufacturers, both the lead firms like Ford and GM and their big suppliers like Denso, for example, are also right there. They've been in conversation presumably for years, but yet still this seems to be an ongoing challenge. So we dip down to the sort of micro level, the micro sort of institutional level. I think this is a big problem and a tough problem in many contexts, not just in the US, I think in other contexts as well, about trying to figure out what are the precise kinds of skills that industry needs and trying to ensure that educational institutions provide those skills. So it's not, so resources generally is important, so we need to invest in skills training in terms of money. But there are also more complex, more knotty, more difficult problems at the micro scale as well around what kinds of skills training is necessary. And these are crucial both to ensure that businesses in particular places, so Brazilian businesses, for example, remain globally competitive on one hand. So it matters for the firms, but it also, of course, matters for workers in trying to ensure that 19-year-olds, 20-year-olds, 21-year-olds who are willing to invest in getting new skills will actually be able to get jobs and be able to earn the kinds of incomes that will allow them to transform their own lives, transform the lives of their families, and so forth.
Good afternoon. My name is Cristiano Saito. I work with public transportation. And one aspect that we saw in Brazil is that we are convinced that we have a very productive public transport system that was fully based on tariffs, very bad quality system, but fully packed buses, and then it was paid. Recently, the ridership of public transportation has fallen massively, and ride-hailing platforms have grabbed some part of that. And in terms of the comment that you have about subsidies, what we see today is that Uber Pool or the shared systems are taking these public transport users. And whenever the price come to the correct level, we might not have a public transport system in place anymore in developing countries. I think this is a key aspect in this comparison between developed and developing countries. Everything needs to be done in terms of developing countries for mobility.
Great, so thank you very much. So this is a huge problem, and one which is at the center of discussions, I think, especially amongst urban planners. So I teach in our urban planning department, and this question about what the long-term impacts of ride-hailing might be on public transit is crucial in both developing and industrialized country contexts. So I guess I'll say maybe two things. So one is that, so I'll say one thing, which is what at least I think some of the ride-hailing companies say in response, just to kind of the conversation. So ride-hailing companies recognize this, and at least ones that I've engaged in different places. But some will suggest that, some will question the extent to which ride-hailing really is resulting in this kind of switching. There's some places where the data that has been collected seems to be quite strong in suggesting that they have. So New York City is an example. In Sao Paulo, my understanding is there are debates as to whether ride-hailing is the cause of this switch, or whether it has to do with other policies that continue to incentivize private car ownership. And so this is one of the things that ride-hailing firms in Brazil will say. And so one of the things that it helps to, and so I don't know the answer. We could know the answer, or we could get closer to getting an understanding of the answer based on the data that ride-hailing firms have, but this data would need to be shared with transit authorities, for example, in order to do appropriate studies. This has been a challenge in most parts of the world. It happens in some places, but not in most. And it's one of the examples of instances where I think we need closer business government interaction in order to address some of the challenges that arise with digital services. So we couldn't know the answer, but we're not really sure. But there maybe are questions as to what to what extent it's ride-hailing or private car ownership. So the good thing about that is a couple things. One, it brings private car ownership onto the table. This is something that ride-hailing firms everywhere are very strongly against, as are your conventional urban transportation planner, for example. There's consensus that high private car ownership rates are bad for congestion, for carbon production, safety, etc. And so sharing is, in this respect, better. So this, one of the things we can do is start to think about ways to get to some of those kinds of common policy goals, and a lot of interesting things are happening in Sao Paulo in this respect. The one other thing I would say, which I've forgotten, in response to this is that the other thing that ride-hailing firms have the potential to do, and I think urban transportation planners make this claim often, as do the ride-hailing firms, is to serve as feeders into the public transit system. So right now, in most city contexts, I agree, public ride-hailing and public transit largely compete. But within that system, also right now, ride-hailing also complements public transit in important ways in providing last-mile services and so forth. One of the things that ride-hailing representatives of ride-hailing firms will say publicly quite a lot is that they would like to do more of this. So they like to serve more as a feeder. So this is the way in which they see themselves as playing a productive role in the urban transportation system in cities, providing last-mile services, providing feeder services, providing services in areas that are not currently served by public transit, especially BRT and rail lines, so the most efficient forms of public transit, but rather perhaps shifting to provide services in areas that are underserved by public transit. But in order for that to happen, again, we need to have more interaction and engagement between ride-hailing companies and public transit, such that the systems can be integrated in a way that would be certainly beneficial for mobility within the city, have environmental benefits as well, and probably also be beneficial from a profitability perspective, from a business perspective. There's a good business case for this, for both public transit, which oftentimes is privatized, by the way. So it's public transit, but these are often private firms, so firms that have a profit motive, as well as ride-hailing companies, which of course are profit-driven as well.
I think we have time for one last question. Okay, sorry for that.
One information and one question. I was a meeting yesterday, and the person from Public Policy from DD 99, she mentioned that they conducted a survey, and the number of users that come from public transport was only 13%, and 54 coming from private auto, and she didn't mention about the rest where they're coming from. So it seems to be smaller than what we usually think.
Right.
In São Paulo.
In Sao Paulo.
And for Didi, I don't know if it's the same number for Uber or not.
Right.
I never heard a number for Uber. Well, the question now is, I believe you skipped your slide on regulation.
I did.
Yeah, you did. Okay, well, we know that countries and cities are responding differently to the presence of ride-hailing companies. So what were you going to say? What is the trend? How you see it?
Yeah, sure. So the event that you're at yesterday, was this the World Resource Institute event? This is a WRI event yesterday, correct? Yeah. So I heard about the event as well. I heard it was a good discussion. So on the first point, what I think is interesting perhaps in Sao Paulo, and I can't even generalize this to other developing country cities, but I think it's generalizable if we take, again, so as a political economist, if we think about the organizational structure of our society, so class. And one of the things that I think we see, it seems in Sao Paulo, this is my understanding, I could be very much wrong, is that the most people who use ride-hailing in Sao Paulo may not be the modal users of public transit because of the big class distinctions in terms of who drives a private car, who uses private cars, and who uses public transit. This is my understanding. And so if that's the case, that we see public transit primarily being used by lower income groups, which may not be the same as private car owners. So the other way of looking at this is, if I own a private car, do I get up every day? So I live in Boston, so I own a private car, and I actually get up every day and I make a decision, do I drive to work today or do I take public transit? And there's not a huge difference between the two in terms of how long it'll take me, et cetera. It's actually cheaper to take public transit, obviously, and sometimes easier, but sometimes a little bit quicker to drive. But that's a decision I make every day. The question to be asked, I think, is would my counterpoint in the Sao Paulo context, a private car owner who has the the ability to either take public transit to work or drive their car makes that same daily decision. I think in some contexts, some country contexts, some city contexts of which some people suggest that Sao Paulo is one, this isn't really a decision. Private car owners just drive. In other contexts, like Boston, for example, this is a decision. In places like New York, it's a decision between maybe taking public transit and not driving your own car, but using ride-hailing. So I think what I'm trying to suggest is that I think in order to answer this question, we need to think about the social structures in our society and what members of society use what modes of mobility. And again, because I'm a political economist, it's not just about sort of segmenting society in this way, but also thinking about the politics that this generates. So what kinds of policies, so do the policies that are private car owner friendly, for example, in cities like Sao Paulo, are these policies that are designed to appease a particular groups of private car owners who are wealthier and so forth? And similarly, if we put those policies that support private car ownership in tension with policies that support public transit, for example, do we have more bus lanes or less bus lanes? So dedicated bus lanes means less lanes for private cars. This is a direct trade-off between the two. And so there's a politics behind this as well. And so I think this pushes us towards thinking about this particular aspect of the political economy of ride-hailing, of public transit, and of private car ownership altogether. I hope that's a reasonable answer. Okay, on regulation, I'll try to say this in a minute. We can talk more. Yeah, I skipped that slide. I probably shouldn't have. So Sao Paulo, I'll first say, has by far the most interesting, I think, sophisticated ride-hailing regulation of any city that I've seen. And this is fascinating for a number of reasons, not least because we tend to think about like sophisticated policies coming from the global north. I'm very happy, especially as somebody from the global south, that in fact, in this and other cases, I think the most sophisticated ride-hailing regulations are being generated in the south, in places like Sao Paulo, in places like Jakarta, for example. And so what I was going to say in the regulation slide is simply the following. In some cities, we see really strong resistance to ride-hailing. In some cities, we see basically, cities doing almost nothing. And the cases where we see cities doing almost nothing vary from places like Dar es Salaam, where I'm also doing some of this research, where the city really has done nothing to regulate ride-hailing, so it's an open market, as well as, in fact, most cities in the United States have done little to nothing. So at most, you have to put a sticker on the car that says you are driving for Uber and Lyft, and that's more or less it. New York is the exception in the US context. Very recently the exception because they've mandated, they both put a cap on the number of ride-hailing vehicles, precisely because of the congestion and switching story. So in New York, there's empirical evidence to suggest that that kind of switching is really taking place, that ride-hailing is taking riders off of the buses and the subways, and also it's contributing to congestion. So we see a cap to deal with congestion, and also a minimum wage, which requires data sharing on the part of ride-hailing companies. The same kind of data sharing that's already taking place in Sao Paulo. But Sao Paulo has gone much further. So not just the policies that were put in place a couple of years ago also have the potential to do things like address spatial inequality, so having lower priced rides in underserved areas, address issues of gender equality, lower priced rides for women drivers, to incentivize more women to be ride-hailing drivers, to provide this kind of work, or to make this kind of work more attractive to women. So really kind of interesting regulations in the Sao Paulo context based on, again, sophisticated engagement with the underlying data that ride-hailing produces, and also being able to push the ride-hailing firms to share that data, which of course has been a big challenge everywhere in the world. So that's most of what I was going to say in my regulation slide.
Okay, thank you very much, Professor Jason Jackson. Thank you very much for being here with us. I would like also to thank SLO MIT Latin American office for being here, and I hope we can have you here in future opportunities. Okay, thank you, everybody.